Good evening, everybody. My name is Sid Redner. I'm a faculty member at the Santa Fe Institute, and I'm honored to be introducing tonight's activities. So on behalf of the Santa Fe Institute, I first want to begin by thanking Thornburg Investment Management for their continuous and generous support of this lecture series. I also want to thank the Lensic Performing Arts Center for their continued additional support of the SFI. I also want to thank the ushers, who always are very friendly and accommodating and make it a pleasure to come into this theater. Now, even though you've been seeing advertisements flash by you, I've been asked to give 2 advertisements, even though you've read them many times. So I just want to, these are upcoming events for the Santa Fe Institute. So on October 13th, there'll be a presentation by Jeffrey Ernstoff entitled Interplanetary Film Scores, Art, Craft, and Science. So what goes into making a great science fiction film score? What are the tricks of the trade? Then on October 17th, there will be a panel discussion led by Professor Manfred Laubischler, who is an external faculty member at the Santa Fe Institute, and he'll be leading a discussion entitled The Past, Present, and Future of the Anthropocene. And here we're going to be grappling with serious issues about how do we, in a planet of roughly 10 billion people, consuming prodigiously and emitting prodigiously, how are we going to sustain ourselves? So now let me turn to the main course of this event, which is the second half of a 2-part lecture series under the auspices of the Stanislaw Ulam Memorial Lecture, presented by Professor John Geanakoplos, James Tobin Professor of Economics at Yale University. So yesterday, he presented a number of things that I thought were very compelling. He presented actually a frightening graph about the performance of the GDP and how the economy has taken a $2 trillion hit that we haven't yet made up, and why is it that that happened? And he also presented some very compelling data about the alluring and pernicious effects of leverage. Leverage is great when your investments are going up, and leverage can really kill you if your investments are going down. And one of the more serious downsides is when people get underwater, as what happened in the 2008 crash, and there was people holding mortgages where they owed more than the house was actually worth. And so Professor Geanakoplos was advocating to restructure the debt to lower the principal payments. And in fact, the Huffington Post characterized him as the economist that Obama should have listened to have prevented the crash, or to at least have alleviated the effects of the crash. So this problem of debt forgiveness is a very tricky issue because it's somehow at the intersection between economics and morality. And hopefully we'll learn tonight more about what we should do about debt forgiveness.
Well, I've heard Sid give many talks, and each time he speaks, it's on a completely different subject. I mean, he talks about, the last one I heard was on figuring out whether in basketball games the score is moving randomly, or whether, things happen in the fourth quarter that don't happen earlier. And listening to him introduce me, I was getting afraid for a minute there that he was going to give my talk, but which I'm sure he could. But in any case, thank you for the introduction, and I'm glad to be here again. And I'm going to continue from where I left off, except I'm going to spend a few minutes reviewing, just in case there are some people here who weren't here the first time, and maybe a little repetition is a good thing. I find that when I teach my class, it actually helps. So bear with me a little bit when I remind you what happened before. So we said that there are thousands of years that people have been talking about debt, and lots of wisdom is accumulated. We've created central banks to deal with it, and debt's even bigger than ever. So if you look at the ratio of American spending to GDP, the blue line is government spending, and you see that years ago in the 1800s, it was extremely small, practically nothing, or 20% of GDP. And then after World War II, it soared to 120%. Then we paid it down incredibly quickly. 30 years, the greatest generation. They fought the war, and they paid the debt down. That's why they're the greatest generation. Now, it's interesting that in those 30 years, as they were paying it down, only twice, in 1948 and 1949, did they pay more than 3.5% of GDP on paying the debt down. So it was gradual, and it relied on a growing economy. It wasn't just they suddenly decided to pay the debt down all by themselves. But still, the name fits, the greatest generation. Now, since then, since they retired, debt's been soaring again. And so you see how high it's gotten. So the problem of debt has not only been with us for thousands of years, but it's more with us than ever. Now, as Sid reminded you, I put a picture last time of the growth in GDP, and we saw that there was a tremendous dip during the great crash of 2007. $1 trillion was lost instead of $1 trillion gained, and since then we've been $2 trillion behind where we might have been had the curve kept going. So we've accumulated quite a loss by now, something $10 trillion, something like that. A massive loss that could have been put to better use. So it's high time that we try to avoid something like that again and rethink a little bit our central bank policy. Now, of course, many people are thinking about this, and policy is changing. And although the theory I'm presenting is something that I thought of before the crisis, I'm sticking with it. And I think there are a lot of people who have similar thoughts nowadays. So I think that's a good sign. So I'm optimistic about the future. So we said that the old consensus, the old macro consensus, which is still the consensus of the newspapers, is that the interest rate is everything. That the job of the central bank is to raise interest rates or lower interest rates to slow down the economy or speed it up. The trouble with that, the very first problem you might think of is, what does it mean to say credit conditions are tight? It can't be that business people think the interest rate's too high or too low when they say that. They mean that they can't get a loan at the going interest rate when credit conditions are too tight because the lenders are afraid that they might default. So default is the thing that was missing in the original tradition. So I described last time how lenders, being sensible, are going to try and impose constraints on the borrowers. They'll say, if you really want to borrow for this interest rate, you're going to have a respectable LTV, a respectable FICO score. Those are the two most important things. What's the loan to value with respect to the collateral, and how good a credit rating do you have? I'll describe that a little bit more in detail. So this is common sense, and Shakespeare knew about it 400 years ago. So did others. We told lots of stories of people who understood that credit conditions might be even more important than the interest rate. And the idea was that when credit conditions get looser, people can buy more. They can get the money to buy more and demand more, so the prices go up. And when credit conditions get tighter, it's hard to find the money to buy, and the prices go down. Now, one subtlety I didn't mention last time, which I think is interesting, is that logic suggests that the looser and looser credit conditions get, the higher and higher the prices are going to be. So it suggests that if you get to the ideal situation, the arrow situation I described a little bit at the end of the last lecture, where you can borrow whatever you want. Everybody trusts everybody. And you're able to borrow. Of course, you're expected to pay back, but everyone trusts you. They don't ask for collateral. They don't check your credit rating. They just assume you're going to pay back, so you can borrow even more. You'd think that by the previous logic, the prices would get even higher, and that this lack of trust just depresses the economy and squeezes things down. And maybe when things get loose, we're going back to the ideal, and when things get tight, we get squeezed more, and the ideal's always way above us. But actually, that's not right. So the interesting thing is that the prices can be much higher than they would be in the idealized world. And I think I've skipped a few slides, but anyway, I'll finish with this thought. So the reason they can be much higher than they would be in the idealized world is because if housing, say, is the only thing that you can use as collateral, that means it's the only thing that you can use to borrow. So that gives it a collateral value, an extra value beyond what it would have in an arrow de Brue world, in an arrow world. In the idealized world, you don't need houses to borrow, you can just go borrow. But in a world where you need collateral, and only a very few things are collateral, they get an extra value. Not only that, but suppose you want to bet. Suppose that a house is worth 100, and you think it's going to go to 120, although you know it might go to 80. But you're optimistic. You think it's going to go to 100. If you buy your house and sell it for 120, you've paid 100 and you've made 20% profit when it goes to 120. But if you put $20 down and you borrow 80 and then it goes to 120, you end up paying back the 80, leaving you with 40. You've made 100% profit. In fact, if you could leverage 5 to 1 like that, you could buy 5 houses, and that's what some flippers do, and you could end up selling, all 5 of them at 120 and make $100 or lose $100 if things go in the other way. So if you want to bet buying houses, which can be leveraged, you can borrow when you buy them, it gives you an ability to bet that you wouldn't have otherwise. Now, in the idealized world, you can bet without having the house. So this collateral value that the few things that are good collateral have gives a tremendous boost to the price. So the prices can be much higher than the idealized prices would be, even though the only way people can buy these things is to borrow, and you'd think that more borrowing, the ability to borrow more, would push the price even higher. It's not true. If it's one of the only things that you can use to borrow, its price is already higher than it would be in an idealized world. So that's what gives the possibility of things getting way too high and then getting way too low. So here's the picture we showed last time of housing prices. This is Schiller's famous diagram. Housing prices in green, rising from 2000 up to 2006, the second quarter or something of 2006, 90% in 6 years, 7 years, incredible increase, and then precipitously falling. And the next to it is the loan to value. This is not extreme cases of loan to value. These are half the loans, non-government loans, and I look at half those people, the top half, so basically a quarter of the borrowers, and what's their average LTV. So this is a deal a lot of people could get, and you see that it tracks pretty much with the prices of housing. The LTV tracks the housing price. It predicts it pretty well. It explains it, you might say, pretty well. Now let's see how interest rates would have done. Remember, houses start at 100 in this diagram on the right in 2000 and go to 190 in the second quarter of 2006. So from 2000 to 2006, straight up, and then sort of they hover a little, then straight down. Let's look at the interest rates. Now these are the yield curves. So the yield curve is the most famous object in finance and maybe in macroeconomics. That's the thing the Fed tries to control. What's the interest rate at the short end? And they can pretty much determine that. And they try to influence the interest rate at the long end, although they're not that good it's difficult to affect that, but they can do that too. So let's just see what was happening with the interest rate. How do I, there's no pointer here. I suppose I'm supposed to use my finger. No, I don't see the pointer. Well, here it is. It's come out of nowhere. Okay, so on the right you see the year. This is that's 2000, okay? So the interest rates are 6% at the short end. Then they drop to the green. I'm obviously not going to be good at this. They drop in the green, here they are in 2000. Then, remember there was the crash of the internet stocks and things like that. So Greenspan decided he was going to lower the interest rates. So he lowered them from 2000, he lowered them all the way to, God damn it, all the way, sorry, didn't hear that, all the way to here in 2001. So then next year, they went even lower to the yellow thing. And the year after that, they went to the blue one, which is starting at 1%. So that lowering of the interest rate suggested to some people that maybe the interest rates were starting to make housing prices go up. But then what happened in 2004? Well, you jump all the way to the brown thing in 2004. Okay, and in 2000, this is the thing where it's 2.5%. Then in 2005, it jumps to the brown thing that starts at 4%. And in 2006, it jumps to the green that's starting there at 5%. So the interest rate, well, went down for a few years, but then the next 3 years it was going up, and it was back to where it was before. And meanwhile, the housing prices just kept going up. Then what happens after 2006? Well, it jumps down. Now they're worried. Bernanke's in control. Bernanke's the one who was raising the interest rates. He's worried that something's going wrong in the economy, so he lowers it to 3.5%. That's the blue. And then he lowers it in 2008 to the light blue, which is at the very bottom, 0. Okay, so the interest rates are now at rock bottom, and they stay there for years. That's what's supposed to make every price go up, but the housing prices just keep going down. So clearly this is an example where the interest rates weren't controlling the housing prices. The Fed is waving its hands and going up and down, and it's not doing anything to the path of interest rates, whereas the leverage is. So since I got behind a little bit, I'm not going to talk about something very much that you might have wanted me to talk about, which is student loans. But there are not very many things you can use to borrow on except housing, maybe cars, and student loans. Students can borrow by going to school. Education is a great collateral. You can borrow a tremendous amount of money that no one would dream of letting you borrow if you weren't going to school. So you would expect that as more and more borrowing became available, you can leverage your education. The price of education was going to go up. And sure enough, it has. So probably that won't come as a surprise to you. A number of years ago, actually there are a number of people who predicted this. But it's been a tremendous increase in tuition and a tremendous increase in student loans. Now, I'll come back at the end and talk a little bit about student loans, but that's one of the punchlines in case I don't have much time. So now that we've got the idea of leverage raising asset prices and lowering it, and FICO too, the question is what drives FICO and leverage? Well, FICO is a little bit like, when they measure FICO, it's a combination of they're trying to determine what kind of person you are, what kind of proclivity to default you have you defaulted before? And they're also trying to look at your financial situation to see, whether you've got the means to, whether you're hugely in debt in other things, then you're probably at risk to borrow still more money. So part of it is like the Nietzschean conscience that's been, they're seeing what kind of conscience do you have? So I think of it as a penalty, maybe a self-inflicted penalty you pay if you default. The higher the penalty, the less likely you are to default. So of course, as conditions get better, the reasons for you to default get lower. So the same person, the same FICO score, a lender is going to be more likely to lend when the economy is doing better because that person's less likely to get into trouble. So of course, credit conditions in FICO are going to get better when the economy gets better. Secondly, about leverage. Well, it's pretty obvious that as the world gets more dangerous, lenders are going to be less likely to give a lot of loans per dollar of value that's being used as collateral. So uncertainty. Now, uncertainty is a little bit of a vague term, so volatility, just this is a technical term, but how much does the price of the asset move? How likely is it to go down? That sounds like it ought to be the determining thing for leverage. So the example we just gave in the two-state case of the house that can go up to 120 or down to 80, it creates a credit surface, last time we talked about, where if you put loan to value on the horizontal axis and what's the interest rate you'll charge on the vertical axis, up until you're promising 80, there's no risk. The lender, the collateral is going to cover it. So the interest rate is going to be more or less the same. But as the promise gets above 80, now there's a chance in the downstate that the loan won't be repaid. And so the interest rate is going to go up and go up quite sharply, as a matter of fact. So a lot of people are probably going to gather around this 80 thing where there's now a risk that's growing. A lot of borrowers will congregate there. In the two-state world, they'll all congregate there. It's just a property, a mathematical property of two states. You can work out that it's always, no one is going to end up choosing a higher leverage than that. But of course, in a more realistic situation, there will be people choosing higher than that. But anyway, in any situation, there'll be a lot of people at 80. So 80, that's determined entirely by the volatility. It's just the relationship between 120 and 80. How big is the drop? And that's the definition of volatility. So in the two-state world, literally, volatility is going to determine how much leverage there is. So that's sort of the theoretical point. If you just test it empirically, you can look. A few days ago, I got somebody to plot on a graph for the commodities market the implied volatility that, if there are options being traded, you can figure out what people think the volatility of the commodities are, and the margin that they're charging. That's the opposite, the inverse of leverage. How much do you have to put down? And you see as the volatility goes up, the margins go up. And then this can be tested going backwards for, I forgot how long we did this for, but let's say 6 months or something. And so you get this more convincing demonstration of the same relationship. It's not perfect because the world isn't two states, but the general idea that as the world's more volatile, leverage is going to go down, or margins are going to go up, that's clearly true. And here's an example of a commodity, natural gas, and what the leverage is. Okay, so that's a crucial second idea, that FICO is controlled sort of by how good the economy is, and leverage depends on how risky the economy seems to be. Well, if you look at the history of ups and downs, this is the Dow Jones Industrial, every day you can see the three most important facts about prices. The first, that we're all familiar with, the efficient markets hypothesis, is going up and down seems to happen randomly. If the stock went up Tuesday, there's no reason to think it'll go up Wednesday. It just seems to happen randomly. The second fact is that these ups and downs, they get bigger and more violent, and then they subside, but the big moves cluster together, so it's clustered volatility. If it's very risky yesterday, it's going to be risky today. If the price is moving around a lot, it'll continue to move around for a while. The third thing is that if you look at the dates, these big moves, the beginning one is the crash, 2930, the depression. The last one is 2008. It turns out that things move, volatility goes up with bad news. So here I got the same picture for the Standard & Poor's 500, and I did it up to yesterday. And so you can see how low volatility is right now, incredibly low now, as a number of questioners pointed out yesterday. I just wanted to confirm that they were right. So volatility's gone way down. So anyway, volatility is countercyclical. So if you look at the VIX, that's the volatility level historically in the blue line, it goes up more or less when the world's going to hell. And so you can see it's going the opposite. And if you look daily, you say, did the S&P go down yesterday? And if it did, what happened to volatility? If it went up, what happened to volatility? And you see that it's inversely related. So bad moves to the left, a bad move in the stock market gets people jittery, and volatility goes up. It's what you'd expect. If you go to if you're waiting for an airline, I have to take a plane at midnight tonight. If you're waiting for the plane and someone says, you hear it's a delay, you're going to be a lot more uncertain about what's going to happen than if someone tells you everything's going well. When you hear it's a delay, you start to get worried that a lot of things, could be a big delay, and so that's the way the world works. So the basic idea of the leverage cycle is that if the economy is improving, probably volatility is declining, that means credit standards are loosening, and that gives a boost to prices, which gives a boost to the economy, and so that improves the fundamentals. Everything's looking better, and you go round and around in the circle. But then something can go wrong, because if you go around a few times in the circle, things start to get more vulnerable. And that's the last thing I want to remind you of, and that's what causes the bust. So let's take this standard example. When I think of things getting worse and things getting more volatile, I think of that waiting for the airplane. So here you see that the payoff of the asset on the right, that column, it can be either one, so things can go up or down. Okay, you're at zero and things can go up or down and then up or down again. And every household H stands for a particular person, each H has a probability of things going up or down. So the higher H, those are the optimistic people who think things are probably going to go up. Now, the payoff at the end is 1 a lot of the time, and only if everything goes wrong. You go down twice, do you get 0.2. So that's what I think of as what happened in the crisis, It wasn't just one event. It isn't like we woke up one day and everyone said, oh, the world's gone bad. It was every week there was another piece of bad news, another one and another one and another one. So what happens when you get a piece of bad news, if you go down, well, then you're closer to the chance of getting a 0.2. So your That's bad news. But also, your opinion is now more volatile because what you think at D is going to be the average, if you're H, of 1 and 0.2. It's going to be between 1 and 0.2. So at 0, you could go either up to 1 or down to something like 0.7. So it's not that big a gap. But once you go to down, it could be 1 or 0.2. Now it's really volatile. So that's what I have in mind. When things start to go bad, people think, oh, well, enough bad things like this, and we're going to have a real problem on our hands. You know, Trump says that 12 more times, something really might happen. And so volatility, by the way, volatility hasn't gone up through the first 75 Trumpisms. But anyway, so volatility is going up as you get bad news. So that's the thing that I have in mind. Now, all right, let's examine what happens in this situation. Suppose that there are a bunch of people, as I said, indexed by H, so they're optimists and pessimists, and everybody knows the price of this asset is going to be 1 if you go to up. But if you go to down, what will the price be? Well, if you're somebody who's very optimistic, let's say H equals 0.87, you think even if you get to down, you're probably going to go up anyway. So you're not going to change your mind that much. Actually, you think it's worth about 98 at 0, and by the time you get to down, you think it's worth almost 90, because it's 87% to 1 plus 13% to 0.2, which is 2.6, so 89.6. So you go from 98 to 90, 8 points. That's how much you think, that's how the extent of the bad news. But the price in this economy is going to go from 95 to 69, 26 points down. Nobody, no matter what your H is, you're not going to think things have gotten that much worse. If you're a very low H, you would have thought you're going to get to 0.2 anyways. You haven't learned anything. If you're a very optimistic H, you think you're always going to get to 1. So there's no H that could explain such a big drop. But the economy is going to drop that far. And why is it? Well, basically, it's because there's not much volatility at the beginning. It means the lenders are going to lend a lot of money. Very few people are needed to buy all the assets. In fact, on the left-hand column, just 13% of the people, because they can borrow so much, can hold all the assets. So 87 is the critical marginal buyer. Her opinion is the one shaping the price. Now, if things, and she's well aware that things might go down. She's not crazy. She's aware that's a possibility. She knows how bad it could be. She just doesn't think it's going to happen. So if it does happen, all those people who borrowed so much money, remember, if you're leveraged, you have a multiple loss. And they've borrowed a lot, these people, these top 13%. They're going to be wiped out entirely. And so once they're wiped out on the right-hand side, when you hit down, they're going to have to be new buyers. The new buyers aren't going to be as optimistic. Not only that, but they can't borrow so much anymore because they're in that uncertain down state where lenders won't lend them very much anymore. So you're going to need a lot of them to buy. So the marginal buyer is going to drop all the way from 87 to 61. So that's why the price fell so much. 87, her opinion was what set the price originally. Her opinion, if you go to the right, the same person, she still has a slightly lower opinion. Maybe went from 98 to 90. So, okay, her opinion went down a little bit. But she's no longer relevant. She's been wiped out. And the new buyer is someone much more pessimistic, and the price is going to reflect his pessimistic opinion, and that's why it fell so much. So that was the basic story last time. So bad news causes a price drop because everyone's opinion goes down, but the leveraged buyers are the ones who lose the most, and they're the buyers. They're the ones who kept the price up, and they're disappearing, and now the new buyers can't borrow very much, so the price has to go really far down. So that is, I believe, that's the story I told, and that's what happened at Ellington, basically. And that's the story I told in 2000. That's what I think happened in 2007. So let's see what did happen in 2007. The usual explanation is that housing was critical, and there are all these mortgage derivatives written on housing, and the whole economy was pyramided on housing, and nobody thought housing could possibly go down, and they were shocked when it went down, and it went down farther than anyone expected, and that's what destroyed the economy. There's a lot of truth to that. But why did housing go down? That's the part that they don't explain. Schiller explains it by saying the narrative changed. It went up so many times before, people started saying it can't keep going up, it's going to go down. And then someone else would say, really? I better sell my house then, and pretty soon it went down. So that also has a lot of merit. But my explanation is that it was the story I just told. So what was the little piece of bad news? Now let's look again at this old picture of the housing price. In 2006, housing prices stopped going up. That's not a remarkable thing. They were going up and up and up because people were leveraging more and more and more. Every year you could put less down. Well, you can't put less than 0 down. The average down payment was 2.3%, we said, in the second quarter of 2006. You couldn't put much less down than that, so housing prices weren't going to go up much higher. But why did they start going down? Something happened. Well, what happened is, you probably know the way subprime mortgages work is they're pooled together and then they're cut into pieces. So there's the triple B piece at the bottom. So if anybody defaults, that bondholder loses the money. Then there's a double B piece and an A and a triple A well, anyway, it doesn't matter. There's A's and A. So the point is it goes up and up, and the people at the top, the A class, they're protected by the people below them. So there are a lot of people who wanted to short these subprime mortgages, and you may have seen the movie The Big Short, and these 3 guys in particular, they wanted to short it, so they persuaded, but they couldn't short it, so they persuaded the right commission to create they had to get permission from lots of organizations. They created a derivative called an index called the CDS index on housing, which hadn't been there before. So that was created in 2005, and it's a different index on each tranche of the pool. So you see in 2005, it's at 100. And then what happens at the beginning of 2007, it suddenly, the end of 2005, it starts the end of 2005, then at the beginning of 2007, the end of 2006, it starts to go down. The triple P pieces go down a lot. So that was a big shock, but where did that come from? Why did that price suddenly go down? What was the thing that was so surprising, the little piece of information that made people realize the world was worse than they thought? Well, if you look at subprime loans and the delinquency rate on all the subprime loans, these went back, for a long time. It wasn't just something started in 2005 or something. So every year you can see, this is the countrywide vintages. So for each starting year on the bottom, you can see what were the percentage of people who were delinquent. They weren't paying their loan. They hadn't gotten kicked out of their house yet. And so you can see every year, going back way farther than this, it would asymptote to 2%. At the beginning, nobody would default, or eventually more people would default. Some people would get thrown out of their houses, so they weren't actively in default. So this number 2% of people actively in delinquency, would always just asymptote there. But then you see that if you look at the 2005 number, that's the yellow line, and you look in 2006, it's gone above 2%. It's already 3.5%. The end of 2006, in fact, it's 4%. And the 2006 one, which is only a year old, here it's already gotten to 3%. And people are saying, my God, what's happening? These borrowers aren't as reliable as we thought. Maybe we've overstepped our bounds and given loans to too many people. Maybe things are going to get worse. Now, 3% delinquency is nothing. Even if all those people got thrown out of their houses, it would be nothing. It's not a big deal. The subprime interest rates are much higher, so that's not much of a loss. But it raised the possibility that the delinquencies might go much higher. So it meant that the triple B pieces were much more nervous, and so the price of triple Bs went way down. That meant it was very hard to create a new pool, because how would you sell off the triple B piece unless you could convince people that they were safer? So what happened is that the people doing subprime loans who wanted to create pools started asking for more collateral, so they could say to the potential triple B people, yes, the guy, maybe we have some evidence that things are worse, but these are much better protected than they were before. So that was the news, that was the reaction of the collateral getting tougher, and that's what happened to the prices. That's my story, and I'm sticking with it. So, okay. So why was it such a calamity? It's the leverage cycle, I think, but there are actually a couple more things going on, which are elaborations of the leverage cycle. One is that there was a sort of leverage got higher than ever before, but there was a double leverage cycle. There was leverage going on at the housing level and leverage going on at the securities level. And if the houses fail, then of course the securities fail. But if the securities are failing and you can't do any more securities, that means the loans won't be given to new buyers, which means the houses are going to fail. So it was a symbiotic, the opposite of symbiotic. It was mutually destructive relationship, a double leverage cycle. And then the CDS that I just mentioned, that made it possible to short negatively. So once you can short negatively, that puts tremendous pressure on the other side for things to go on. Leverage was going up and up, but now you could short negatively. So why is that? I mean, what's the operation? Just to think about it, if you're very optimistic, you could buy a house and bet that it'll go up, or you could sell the insurance now that there's CDSs like insurance on the thing going down. So the optimists, instead of buying houses, they're selling insurance. So it moves the demand away from houses or mortgage securities. And then finally, there was also a huge amount of securitization going on. So financial innovation is just an elaboration of the leverage cycle. This tranching of things is a more sophisticated way of leveraging, and the CDS is an opportunity for the pessimist to leverage. So all that together, that elaborated leverage cycle is the story. All right, so that's where we ended last time. Now, I repeated myself a little bit too long maybe, but I hope the second time around is a little clearer. Now, what can we do about that? What pieces of information can we gather to help us do better the next time? So the obvious thing to do, so obvious that it's amazing it hasn't been done before, and it was a lot of trouble to get this data, is to look at credit surfaces. So this is, if you can see on the axes, this is it's easier to see there. It's the FICO score, where at the bottom it's 800, so it's a good borrower at the bottom, and LTV, which is 100 at the top and goes down to below 60 at the bottom. So the best borrower is at the bottom and the worst borrower is at the top, and this is from the year 2006. So you see the interest rate goes up as you become a worse borrower, but it's not going up that much. That's why there are these people taking out these loans, because the interest rate doesn't go up that much. Now, these are for Fannie and Freddie loans. The best people in America, middle America, middle class America, that's who they're designed, who've got great, who have jobs and who have incomes they can report, and these are the best borrowers you can find. The ones I showed before, the non-government borrowers, they're the dicier borrowers. So this credit surface, if you include those other people, would go way up. All right? But anyway, it's pretty flat in 2006. And then you see that most of the borrowers, who are the borrowers? This is the number of people borrowing in each of those areas. You can see that there's this congregation at 80%, and it's middle America, the 750 to 700 people. They're the ones doing all the borrowing. They're the ones boosting the housing prices. Now, let's look at it 2009, say. If you can remember, this is dramatically steeper than it was before. It's the same picture, the same everything, it's just much steeper. And so who's borrowing? Well, those people in the middle, they're still, if you've got an 800 score, you can still borrow. But if you're towards the back there, in the middle and the back, or even, you just can't borrow. So, or you can borrow, but it's getting hard to borrow. So this is the point when the Fed started trying to do all its work, and quantitative easing, lowering the interest rates, trying to do something about this. In fact, they were buying mortgage securities. They wanted to help the mortgage market. But what happens if you look at 2016? It's not much different, the credit surface. And in fact, if you look at who's borrowing, that middle group, the ones with the medium FICOs, they still can't borrow. But if you've got a really high FICO, now you can leverage even more than you did before. That's, I think, why Selwyn last time asked a question and said people are leveraging more now even than they did in the crisis. It's only the people with the highest FICO, pristine people, can now borrow even more easily than they did before the crisis. But everybody else is having a hard time. So the efforts of the Fed to make it easier to get a house have not succeeded. Now, the story could even be more dramatic because I took leverage as the ratio of the loan to the value of the house. But in 2006, the housing prices were greatly inflated. If you took another measure of leverage, one Minsky would have approved of more, the rentals, the average rentals that you could get for houses of that kind, and so you took the ratio of the loan to the imputed value consistent with the rentals, then of course you're going to find that the housing prices are much higher. Sorry, the housing prices are, sorry, the rentals, the sort of corrected price of the house is much lower than the actual price, and so the loan is going to be 120% LTV. So the 2006 credit surface is incredibly flat and goes out to an LTV way above 100 by that measure, but the other ones haven't changed at all. So that's what I mean by the credit surface. When the Fed decided that it was going to do quantitative easing, it was going to take extraordinary measures, they just said we wanted to stimulate the economy. They didn't have to say what part of the economy they were stimulating. Everybody figured they thought they were stimulating the mortgage market because they were buying mortgages. But it didn't have that big an effect on the mortgage market. It had some effect. As I said, as we saw, it had some effect, because the very high LTV for the 800 FICOs, there's more of those than there were before. But it didn't have that much effect. But look at the effect it had on corporate America. Here's the credit surface. Now it's reoriented. So here it's that Minsky ratio, debt to income. So debt to how much your earnings are. So on the left, it's debt is 0 to twice as much, and then it gets higher and higher as you go to the right. So the small debt is on the left-hand corner, and then you can see that the AAA is here, and BBB is at the back. So the best borrower is on the left-hand corner, and the worst one is on the top right-hand corner. So you can see these are corporates, and so the interest rate gets higher when you become a worse credit rating or you're higher, the leverage is worse. Well, this is 2005. It's pretty flat here. So what happened in 2011? The corporate world was a little further behind. It got much steeper. Everyone realized the world was dangerous. It was much harder to borrow. But then the Fed kicked in. Here's where we are in 2013. You see, it's flattened that. It didn't change the mortgage credit surface, but it changed the corporate credit surface. And here's 2017. I changed the picture, unfortunately, but it's even flatter than it was in 2013. That was bad. Anyway, I didn't do this. Someone else did this. So actually, it was, I'm not going to embarrass them by saying it was, but anyway, it was a very prominent investor who got excited about the idea, and they came up with the data to draw these things. Let's look at consumer credit. Why has the economy gotten better? So consumer credit, this is the same picture as we had before. So these are from loan, what's it called? Who's the online lender? The famous online Lending Club. So Lending Club data. So this is just looking at all the loans Lending Club has and what the ratings are and what the interest rates are. Here it's 2010 to 2012. Then it goes 2013 to 14 and 2015 to 16. It gets dramatically flatter. Here you see the top one, the worst one, is around 13%, and before it was 18% or something. So it's dramatically flatter. So it's gotten easier to borrow if you're doing a consumer loan or if you're a corporation. It's not that much easier to borrow if you're trying to get a house. And so wouldn't it be nice if the Fed was, and maybe a lot of them are thinking about this. I don't want to say that they aren't thinking about this. But wouldn't it be nice if they had these pictures in front of them and that before they made their policy, they had to say, we're going to act in the markets so as to have this effect on the credit surface of mortgage borrowers, corporate borrowers, and consumer borrowers. Then you would know what they were really up to, and they would know what they were really up to, and they wouldn't be sort of just hoping. They'd actually have to, they'd be accountable for what they're doing. So I recommend that they do this. And not only that, but I recommend that they choose policies that affect the right credit surface in the way that they want to. So I think they might even be doing that, but they're not saying it if that's what they're doing. Okay, so that's my story of the leverage cycle and why we get into messes. And as I said, if you get into a mess where what's owed is so much above the value of the collateral, you get into tremendous trouble. So once you're talking about the credit surface, the whole point of the credit surface, the interest rates are going up because of default. So you can't talk about a credit surface unless you acknowledge the possibility of default. Most central banks don't acknowledge default. They can't acknowledge, by charter, they can't acknowledge the possibility of default. They can't hold things, and they don't mark them like a hedge fund does. They don't take a Greek bond and say, well, the odds are 50%, we're going to get paid, we'll count it as 50. If they hold a Greek bond, it's valued at 100 because they hold a Greek bond and it's supposed to pay. So I say that they should be marking the things that they hold according to, like any reasonable investor would, taking into account the possibility that they could default. Now that's very important because if they mark a bond at 70, say, and then the borrower gets into huge trouble, and then the borrower is so underwater that they're never going to pay anyway, now you have the possibility of forgiving down to 70. Because by forgiving down to 70, you haven't lost any. You already marked it at 70. So it's not a 30%. You already took the 30% loss. So you can forgive 100 down to 70 without taking an additional loss. And by doing that, you might actually get more money than you would have otherwise. You might be able to mark it at 75 now. So I think that was our biggest mistake in the crisis. There are a number of them. Obama is a remarkable person, but a little bit timid. And he did a package, a stimulus package, but it wasn't big enough. And could have been bigger at the beginning. He had the whole country behind him. He could have done almost anything. And the deliberations have been published with him and his advisors. So it's very clear they chose the stimulus that they did. They could have asked for more, but they didn't. Now maybe they were afraid they couldn't have gotten more, but that's leadership. They didn't try to get more. So that was one mistake. But I think a bigger mistake was not forgiving subprime debt, because that's clearly something he wanted to do, but he let himself be talked out of it. So nothing was done, not a single penny of subprime debt was forgiven, and a huge number of these subprime borrowers got thrown out of their houses. Now, what's the logic of forgiving debt? So we have a lot of data on these subprime guys because so many of them got thrown out of their houses. So we know what happens when they get thrown. $400 billion worth of subprime borrowers got defaulted. So we know what happens. It's not a conjecture. We've got all the facts. Let's take a loan that's $160,000 and the house is down to $100,000. So if you're a person with a bad credit rating, that's why you're a subprime borrower, you owe $160 on a house that's $100, the world seems to be going to hell. Why would you pay $160,000 on $100,000, when the house is only worth $100,000? So you probably won't. So when you stop paying, you get thrown out of your house, but you don't get thrown out the next day. It takes a couple years in some states and most states to get thrown out of the house. In that time, you don't pay your mortgage, you don't pay your taxes, you don't fix the house, and when you leave, you probably take as much as you can out of the house. So the recovery of that $160,000, the average recovery, and we have a huge amount of data, was 23%. 35,000, something like that, is what the lender got. If the lender had forgiven the 160 down to 90, which is less than the house is worth, there's a good chance the lender might have gotten his money back. So who were these lenders? They were mostly hedge funds and people like that. These are subprime securitizations. So it's not, a little bank holding them. It's sophisticated hedge funds. So as I said last time, 17 hedge funds got together and say, we own these bonds, we think we can get more money by forgiving the debt than not forgiving the debt. We don't have the power to do it, we just own the bonds. It's the servicers who are controlled by the big banks. They're the ones who are responsible for collecting the money and distributing it to the bondholders. Only they know who the actual identity of the people, who is who. There's privacy, so it's only the servicer who knows who everybody is, and only the servicer has the power to change the terms of the loan. And the servicer had no incentive to forgive any of the debt. For one thing, their fee is proportional to the principal. They cut the debt in half, their fee immediately gets cut in half. they have to go to a lot of trouble to decide how much to cut it. As I said, 160 you should cut to 90. If you cut 160 to 130, you're not going to do any good. So you have to cut 160 to 90. You have to figure out what the house is worth. You have to send people out there to look at the house and decide whether the homeowner is going to be able to pay the 90 even. And so that's effort that they don't get. It's a job they didn't expect to do in such great numbers. Why should they go to all that trouble? The big banks who owned the servicers, they owned almost a huge number of second loans. They were afraid that if they started marking down first loans, then people were going to say, well, all those second loans should be marked to zero if the first loan's getting marked down, and they didn't want that to happen. So they had very little incentive, and in fact, not a single penny of subprime loans were forgiven. So what did we do instead? What we did instead is the Obama plan. So by the way, I wasn't so prescient. I wrote about this in 2008 and predicted that there were going to be these huge losses and that it was a disaster if we didn't forgive subprime debt. Wrote about it with a law professor named Susan Cognac, and then I testified in Congress a couple times to this effect. But it was very easy to predict what was going to happen because I relied on the market. The market was pricing these bonds, and from the price of the market, the hedge fund investor bonds, you could tell how much recovery they expected to get out of these people who were going to eventually default. So I didn't predict myself the recoveries would be so bad. I just looked at what the market thought, and it came out to be the market wasn't so far off. So what did we do? What was the Obama plan? It was to say, okay, if you're defaulting, if you can't pay and we see that you're not paying, you call us up and you tell us you're not paying because you've suffered a hardship. And we'll look into your case. And if there's really a problem, you've lost your job, other things are wrong like that, we will then mark down the interest. Not the principal, just the interest. We'll cut it down to make it easier for you to pay because eventually things are going to get better, and so you'll eventually be able to pay off the whole thing. Well, what happened? First of all, that's a moral hazard. We're going to talk about moral hazards in a second, because in order to get looked at, you have to stop paying. So you got people to stop paying just so that they could get access to one of these Obama plans. So once they got their interest rate marked down, these people, they actually paid a few times. But look at the recidivism. So here, the number of months on the horizontal axis, and what fraction of people defaulted again? Well, turns out that 50% of them by 18 months, 70%, it depends on how far they mark the coupon down, but even if they marked it down a lot, you got almost 50% of the people defaulting again. It wasn't enough to mark down the interest because they still thought to themselves, the house is still only worth $100,000 and I owe $160. What am I doing? So my plan at the time, our plan, Susan Cognac and my plan, our plan was to have the government hire community bankers. So these bankers, these would be local bankers, like a New Haven banker, someone who actually worked in a bank or had experience with a bank and looking at loans, would be hired by the government and told, you look at all these loans in New Haven, you figure out what you can do to change the terms of the contract to make the most money for the seller. If you think marking down the loan will make more money for the lender, not the seller, the lender, if you think marking down the loan will make more money, the principal will make more money for the lender, do that. If you think marking down the interest will make more money for the lender, do that instead. We predict that they're going to mark down the principal. So that was the plan. So is there a moral hazard in that plan? We're acting on behalf of in a way, on behalf of the lender, but you could still say you might think that there's a moral hazard, and people say moral hazard all the time. I think they think it's morally reprehensible. I was told, now this may not be exactly true, and I couldn't quite find the tape in time, but I appeared on TV a lot in 2008 and 9, advocating this, and in one of those conversations, on I forgot which station, they suddenly cut to this guy who was standing on a trading floor in Chicago, and he starts yelling at me. And his name is Santelli. He says, "What are you doing trying to mark down loans for those disgusting people who borrow too much? And who's going to mark my loan down? Why should you mark those?" He's screaming and screaming. I thought the guy was crazy, so I just ignored him. But apparently, I've been told I gave the Tea Party its, its platform, because that was one of the first performances of Santelli, saying that we shouldn't be forgiving debt. Anyway, he, I guess, won that debate. So here's what I was advocating. You could look at that time in 2008 at the number of people, depending on the loan to value, what fraction of them were defaulting every month, what new percentage, the people who are still paying, what fraction of the people still paying started defaulting. And it was for the highest, for the worst, the highest LTV people. Okay, if you had the highest LTV people in your subprime, that's the top line. So if you're 160, like I said, that's at the far right, the percentage of people each month who defaulted was 9%. So you knew that these people eventually were going to default. So I was advocating write down the principle for people who have kept paying. They're still paying. They haven't done anything wrong. It wasn't their fault that housing prices went down. And by the way, they've still kept up all their payments. They're just going to realize eventually that it's crazy to do it. Forgive their debt and you'll make more money. And so who's going to take the loss? Not the government. It's not the government paying it. It's those hedge funds who own the bonds. They're the ones who are going to get the reduced principal, but it's going to end up being more than it would have otherwise. That was the suggestion in the argument. Now, of course, some of those people who you've forgiven the debt may have paid it all. Maybe some of those people were going to pay $160,000, even though the house was only worth $100,000. So there were potential losses, and I've gone to great trouble to try to calculate after the fact, taking into account all the people you would have forgiven who would have paid it all, et cetera. And it turns out it doesn't make so much money for the lenders. The economy did eventually, but you don't lose practically anything, and it doesn't take into account what a boost that would have been to the housing market not to have all those people thrown out on the streets. So that's my story. Now, if you, another way to do this, the sort of more sophisticated way of forgiving principal, was suggested a long time ago by my colleague Bob Shiller. And he said, why not he invented the Shiller Housing Index, so he thought of every possible contract depending on the housing index. He said, if the index in your general area goes down enough, according to the Shiller Housing Index, so you're way underwater, then you should have automatically the mortgage should be written down a little bit, written down so that you still stay above water. So this was an ingenious way that he thought of a long time ago, the reasonable way of forgiving principal up front in case a disastrous thing happens. So that's the reason why college loans should work the same way. If you turn out, people turn out to have very poor incomes, they should have to pay less back. That's why it's so much better to have the loan amount indexed to your income than to have a fixed amount. And if it gets to be too high, that should be forgiven too. But anyway, that was the plan. So now Europe is a very similar situation. And I can't describe the whole thing because I am too far behind. So I'm going to stick with what I know best, which is the Greek crisis. So I told you how it happened, that the Minister of Finance, Euclid Tsakalotos, had heard my talk on mortgage forgiveness. I gave the graduation talk at Athens Economics and Business School. So when he became finance minister, he succeeded this guy named Yanis Varoufakis, who you remember had incredibly tempestuous relations with the Germans especially, and things were looking really grim for Greece. And Tsakalotos was a much more mild-mannered guy, maybe too mild-mannered, but very mild-mannered guy. And so he thought things should get off to a different footing, and he asked if I would help out. So I had to take a leave from Yale, leave from my hedge fund, everything to try and help out. And I didn't provide much help. Just before I went, I got an email from someone who said, you may not remember me. My name is Kostas Geanakoplos. I am a relative of yours, and we met in your grandfather's house in 1963. And in the village outside of Sparta called Theologo. And the village has all read about your intentions to save the Greek economy. And we'd like to celebrate the rebirth of the Greek economy by having a village dinner with you. And so I actually decided I would look up this guy. I didn't really think I was going to save the economy or that they were going to give me a village dinner. I waited a little while till it was obvious things weren't going very well. And then I went and I met not him but his son. And we met in the house that my grandfather had left in 1892 as a 12-year-old to come by himself to America. And the house was still there and was beautiful. I guess I'd seen it in 1963, but I hadn't remembered it. It was an incredibly beautiful house. And in my family, everybody does only one of three things. Either they're professors, or they're musicians, or they're bad tennis players. So he said, I asked him his name. He said, I am John Geanakoplos. I said, wow. I said, what do you do? And he said, I am tennis champion of Sparta. And I said, well, what else do you do? And he said, I am a musician. I sing hip-hop music. And I have 11 million followers on YouTube. And I said, my gosh, you're a professional musician. He said, no, 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 no. He said, I went to graduate school and I got my degree, my PhD in economics at the University of Athens, economics and business. And I worked in the Bank of Greece, but it was so depressing, I decided to quit. And I moved back to the village in Sparta. And now I sell olives from the same olive grove, in fact, from the same trees that your grandfather's family sold back in the 1890s. So that was a stirring meeting, and it made me feel all the worse that I had done so badly. But so let me just remind you of how bad the crisis is in Greece and what I proposed. So it's bad. So it began in 2009 when Papandreou, who was descended, is the son of the famous, is the grandson of two famous prime ministers, and he was born in America and seemed like a very honest guy. And one of the first things he did was he said that the previous government had misled everybody about the debt, the deficit. It was really much higher than people said. We talked about it at the end of the last lecture. So it was much higher, and as soon as he said that, all the lenders began to panic, and they said, my gosh, maybe things are much worse. We're not going to lend to you anymore. So then, since he couldn't roll over his loans, Greece got into tremendous trouble, and he asked for a bailout. So he went to the Troika to ask for a bailout, and that made things much worse. So they decided, so here, by the way, is interest rates in Greece, and you can see when the crisis started, when people realized the bailout wasn't working, the interest rates soared, and they had been getting closer and closer to German interest rates because Greece was about to join the EU. And you can see what's happened to Greek debt relative to GDP. Back in the 70s, it was nothing. Then Papandreou's father, Andreas Papandreou, started borrowing a lot of money, and the debt went way up to 98% of GDP. And then, of course, recently it's gone way up, and now it's up at 100, that's top line, the 180% of GDP. So it's the government doing the borrowing. If you look at the household sector or the corporate sector, they're still not borrowing. It was very different from other countries like Spain or, Ireland or places like that. There it was the consumer borrowing. I don't have time to talk about their problems, but it was very similar to the American problems. In Greece, it was the government that borrowed. So they got bailed out. Now, where did the money go initially that bailed them out? Someone asked a great question. Why didn't they just let Greece default right at the beginning of the crisis? Maybe forgive everything and let Greece go on its way. That might have been the best thing to do. But Greece didn't default. Instead, they got bailed out. So what did that mean, bailed out? It means they were given the money to pay back the previous debt. And so who got paid back? Well, if you look at all the foreign banks that owed money, held Greek debt, you look at every year how much Greek debt they had. Well, when the crisis started and the bailout started, it all got paid off. So all those banks got bailed, they got paid off. The Greeks paid them back. So part of the bailout terms was what was called austerity. They had to take their 15% deficit and cut it down to zero. They had to start running a surplus. So look what happened to their government spending. It fell by 30%, an astounding fall. No country has reduced government spending that dramatically, that fast. And so why why did the Troika think that this was a good thing to do? Well, they all predicted. Each year they would say, look, you take this dose of medicine, you cut everything, you balance your budget, and of course things are going to get worse for a year or two, but then they're going to turn around when the world sees that you've done that, and everything's going to get much better. So here you see the predictions the IMF made each year, starting, whatever, in 2009, say. So they'd always start at some number, things they'd say, well, the next year they're going to get bad, but then they'll start going better. Okay, so they did get bad. Then starting from that same point, I've normalized it to always start at the same point, they made another prediction. Things got worse than they expected even the first year. They made another prediction of things getting bad and turning around. Things got even worse. So the next year they make another prediction. They kept predicting lower and lower and lower. Every year they'd always think it would turn around, and each time they had to make lower predictions. So it was almost catastrophic. If you look at the change in Greek output, it's negative starting 2008 or 2009. This is a very telling graph. You look starting in 2008 at every country, what was their percentage growth in GDP starting in 2007. So at the top is Australia, there's Canada, there's the US. This is up to 2014. A lot of countries are growing, not brilliantly. The US is only up like 5% in 7 years. It's not great, but they're positive, and a few of them are slightly negative. The ones who borrow too much, Denmark and things like that. Italy's down 8 or 9%. There's Greece, down 25%. Just off the charts what happened to Greece. Okay, there's Greek unemployment. It went up to 25% and is still 21% now today. You look at the recession, the change in output. You compare the Greek problem with what happened in 1929 in the US. The drop was bigger in the US, but it turned around after 6 or 7 years. In Greece, it just went down and stayed down. It's still down. So the Greek suffering in loss of output is bigger than the loss in America, percentage of GDP, in the Great Depression. Okay, you look at the austerity Greece had to run compared to every other country, and it's not so surprising output went down so much more because now they were spending way beyond their means, but the 30% cut in government spending is almost unheard of, and it's quite surprising that if you draw a straight line between what countries had to cut what percentage of government spending they cut and what was the loss in output, it fits pretty well on a straight line. And Greece had the biggest cut and had the biggest loss in output. And the Greek situation's even worse than I'm describing because this debt of 180%, it's owed entirely to foreigners. The Americans who owed 130%, 120% after the war, the Great Generation owed it to themselves. It was all American bondholders, not German bondholders. So the Greeks have to pay all the money outside. The debt in euros is much worse than it looks because Greek wages and prices keep falling and falling and falling. It's not their own currency. So actually in terms of wage hours, it's getting bigger and bigger. And finally, the banking system, that's their Achilles heel, which I'm going to talk about in a minute, is in dire straits. So of the 240 billion euros that they had, 120 billion left. So they just disappeared. So how did they get paid off? Obviously, this is the bank run story that I told you other people tell. How could they get, Greece didn't have the money, the banks didn't have the money to pay them. So what happened is the ECB loaned Greece the money to make up for all these deposits. So half their money is now being loaned, they're being propped up by loans from the ECB. So Greece is really entirely dependent on the ECB. Of the loans that Greece has, half of them are non-performing. So they've lost half their depositors, half the loans they have are non-performing, which means they're not getting any money in, which means they can't reloan any money. So what could they do? And now this is the last thing I'm going to say before I talk about what my plan was. It's very hard to start an economy going when the banks can't lend any money. Now, one of the few ways they might get their hands on some money is if they sold off their non-performing loans. Their loans were supposedly for 100, maybe they're only worth 50, that's what they're marked at. So why not sell them off for 50? Well, they really couldn't find any buyers at more than 30. The point is that it always happens in Italy, in Greece, in all these countries, the banks that have non-performing loans don't want to give them up. And that's why they can't get their hands on any new money to lend out. And why don't they want to give them up? There are two reasons. One is they're probably marked higher than they should be, even though it's the ECB marking them. They're probably marked higher than they should be. But a second, more subtle reason is that these loans were collateralized. They're businesses collateralizing them. There are no other businesses that they can use for collateral. So these are the best loans that they have. They can't find any other loans. They can't bet on anything else turning around. So the banks are the people who are bankers almost always pretty optimistic. So this is the best bet that they have. They don't want to give up the loans, and if they sell them to someone more risk averse, they're going to get a lot less money than the bankers think they're worth. That is the crucial problem in all these countries with the non-performing loans. They're the last available collateral, and the bankers don't want to give them up. So they're stuck holding them, and they've got no new money to give to anyone else. So it's sort of a doom triangle. The banks held a huge amount of Greek bonds. So when the Greek bonds started to go bad, they started to lose money. So that means they have these non-performing loans with entrepreneurs. They can't loan to new entrepreneurs. The new entrepreneurs can't do anything. Business is so bad, they're not paying any taxes. So the government's not getting any money, so they can't pay their bonds. But the Greek banks that hold the bonds are losing more money. So it just goes around and around and around, and it can't stop. So what should we do about it? So the IMF spent a lot of time thinking about this. As I said, I think they made quite a few mistakes. Maybe it wasn't easy to predict what was going to happen. They play a very funny role, I think. They're very great people, some of them. The number 2 person at the IMF was another classmate of mine. You saw Takatoshi Ito, who was next to Arrow, who's rescued the Japanese Social Security system by getting them to invest in American stocks. David Lipton is the number 2 person at the IMF. Larry Summers was the Secretary of the Treasury. Ben Bernanke was at MIT the same year I was, so we saw each other all the time. All these people seem to have done quite well for themselves. Anyway, so I think the IMF has a lot of very capable people, but they seem to play a similar role. A country goes badly, they come in, they impose austerity, and then they try to get things turned around, and sometimes they do, and sometimes they don't. So after helping to ruin the Greek economy, I think even they would realize they've made a mistake, they've now become the good guys. So they're saying, so what was the deal that Greece signed? Okay, I forgot to say this. So when Varoufakis remember what happened with Varoufakis? He was the guy who rode a motorcycle and a black leather jacket and showed up to meet all the finance ministers of Europe dressed like that, even though they were all in their suits and ties, and told the Germans they were Nazis who owed Greece money rather than Greece owning them money. And then he said that Greece was going to just drop out of the euro, and so they had a vote in Greece, the yes-no vote. Should Greece accept the terms of the Troika or should they reject it? And 65% voted to reject. And so Varoufakis went back and he said, you see, our people have rejected it. And so the Germans said, well, if you reject the terms, then you're on your own. And so then he went and he tried, they had these conversations. They tried to find out how long it would take to print drachmas, and it turns out it's 8 months to start printing drachmas again. And so they went back and they said, well, we're actually not going to leave the euro, but you're going to make the terms better, we presume, because we've rejected them. And the Germans said, no, we're going to make the terms worse because you rejected them. So the terms became Greece has to pay 3.5% of GDP for about 30 years. 3.5%. Now remember, the US, the greatest generation, only twice managed to pay 3.5% of GDP. And Greece is supposed to do it for 20 or 30 years. That was the terms. And remember that the debt is all owed to external people, not like the American debt to internal people. And remember that Greece hadn't yet to pay a single drachma back, a single euro back. They hadn't paid anything back. They weren't running a surplus, so they were supposed to go from paying nothing back. All the time, all during this crisis, Germany and Europe was lending Greece money to pay themselves back. Greece wasn't actually paying anything. The austerity didn't come from the fact that Greece was paying out so much money. It came from the fact that it had to couldn't run a deficit anymore. It had to change, convulsively change so fast. So it's hopeless. Greece is never going to be able to pay 3.5% of GDP for 30 years. No country could do that. So why don't the Europeans just, I mean, they're very sophisticated. Why don't they realize that and forgive some of the debt? So I think you have to look at it from their point of view. They're not crazy. So what are some of the problems? Well, the first problem is the debt's owed to a lot of people, like to the ECB, the central bank. The central bank has marked it at 100, remember. So if Greece says we're not going to pay back our debt and they own Greek bonds and things like that, they have to suddenly take a loss. So a loss that they haven't taken before, just like with the banks in America. So that would mean that Angela Merkel would have to go to the German people and say, well, we have to refund the central bank because we've forgiven Greek debt. So let's increase taxes. It's a very difficult thing for her to do. Now, another thing is Greece can't borrow. Nobody's going to lend to Greece now. It's almost impossible. They borrowed a few 2 billion euros or something 4 months ago, but almost impossible to borrow. Why can't they borrow? Because they owe so much. No one thinks that they can get repaid. So of course they can't borrow. Well, Europe loves that. They don't want to see Greece get into more trouble and have to be bailed out again. If you're a German, you're thinking, my gosh, we've poured all this money into Greece, bailing them out. We just better make sure this is the last time we bail them out. So actually they're feeling pretty good that they don't have to lend, they don't have to let Greece get into another problem like that. Now, if you forgive Greek debt, you have to think about forgiving other people's debt. And so it's very, very difficult I mean, there's Italy that's, has the huge problems, and Spain that have huge problems. Aren't they going to ask for their debt to be forgiven? And finally, one of the most important reasons is that Greece is still getting money. Germany's lending Greece more and more money, to pay them, to pay the IMF back, to pay private creditors back as well. That Greece actually defaulted on half the private creditors, but there's still the other half to pay that the Greeks can't pay. The Germans are lending the money to pay that stuff off. There are all these hospitals that are going under, and there's, the workers haven't been paid and the doctors haven't been paid. Greece is lending the money to make up for that, to pay the arrears. So Germany has to lend more money. How do you go to the German public and say, the Greeks can't pay the debt, so we're forgiving it. And by the way, we're going to lend them more money that they're not going to be able to pay. It's a very difficult sell. So put yourself in the German spot. It's not so easy for them to forgive Greek debt. So it's not so, maybe they could have done it at the very beginning. By the way, the Greek banks will totally go under if Greece leaves the euro now. So it's not so simple to forgive the debt. So there was a standoff between the Germans wanted to keep the process going, and the IMF finally spoke up and said, no, this is too much you're asking. Cut the 3.5% to 1.5%. Otherwise, we won't bless the plan going forward, and then you're on your own. Now, the Germans, no Europeans want to be on their own. They want to say, it's all the IMF telling us this is what we should do. It's not our fault. We're not, hurting Greeks or other Europeans. We're doing what the IMF says. So they want the IMF there, and the IMF is saying, no, 1.5%, that's all they can pay. So there's the standoff, and that's when I show up. So I had a freshman roommate named Jeremy Bulow, who also became very famous, and now he's a Stanford professor. And I decided to put a committee together, which ended up just being the two of us to do the Greek debt thing. And so this is our joint proposal. So the Germans, Europe is saying you got to stick to the deal. It was 3.5%. The IMF saying reduce it to 1.5%. Neither one will move. So our first proposal is make how much, and every year what happens, Greece can't make the 1.5% or the 3.5%, and then they have to say, okay, you didn't make it this year, we'll lend you some more money, and starting next year, in 2018, now you have to make, it's going to be 1.75%, and the next year 3.5%. Starting then it's 3.5%. But every year Greece doesn't pay anything back, and they have to renegotiate it. It's a huge waste of time, incredibly time-consuming, irritating to everybody. So our first proposal is index what Greece pays to how the economy is doing. If it's doing incredibly badly like now, it shouldn't have to pay very much. And as the economy gets better, the number can go up. So what was our indexing formula? Greek the Greek economy is 180 billion, the government's half that, 90 billion. We said make Greece pay 7% of 90 billion minus 60 billion. Now, it sounds a little complicated, but this is how you get a progressive tax, is by, it's like the negative income tax. You offset it. It's not 70% of G, but 70% of G minus 60. So the first year is 70% of 30, which is 1.2% of GDP. Probably pretty hard for them to pay, but we didn't have the nerve to ask for less. So 1.2% of GDP. As G grows, that percentage grows. And if G is always half of GDP, G is government spending, if it's half of GDP and grows off to infinity, the 60s are relevant, and 7% of half of GDP is 3.5%. So eventually it's 3.5% if Greece's economy miraculously recovers, but it starts at 1.2. You don't have to keep negotiating. If things are bad, they'll have to pay 1.2 again. If they get even worse, they'll pay less than 1.2. So that way you make it sensible. It depends on how the economy's going. You don't have to renegotiate. Now, the trouble with that is that goes on indefinitely. I mean, there's no end to that. So since it requires 3.5% for 30 years to repay the debt, paying starting at 1.2%, and maybe going up a little bit, that's not going to repay all the debt. So Greece is going to be in terrible debt to infinity. It feels awful to be in debt, if you've ever been in debt. To be in debt that you can never repay, it's a crushing feeling. Business is never going to start up if Greece has no prospect of ever paying off the debt, like the 3.5% in perpetuity. So our second plan, now we have to make a plan where we meet the German and European needs to have everything happen slowly. And so they don't suddenly forgive all the Greek debt. We have to make the Greeks think that the debt's been forgiven right away, because once the debt's been forgiven right away, the Greeks will try to pay off the part of it. They'll, 2/3 of it, say, they'll try to pay off the last third. Before 2/3 of it's forgiven, I realize I've gone way over. This will just be one more minute. I'm at the punchline. So forgiving debt is actually good for the Germans in a way, because if you forgive 2/3 of the Greek debt, they'll say to themselves, oh, this 1/3, we can pay that off. We'll start paying it. If there's such a huge amount that they owe that they can never pay it off, why should they pay any of it? Why pay taxes if you know your tax money is going to pay a debt that's still going to be infinite? It's not that the Greeks are so crazy and so dishonest that they're so reluctant to pay taxes. The money's going to pay a debt that can never be paid off. You cut that down, you'll get a lot more people willing to pay taxes. But you have to make the Germans think you haven't forgiven it right away. So how can you have the Greeks think it's forgiven and the Germans think you don't? Okay. So our second plan was, every time Greece pays back €1, you count it as 3. So the Greeks are going to say to themselves, well, we only have to pay 1/3 of the debt because they've forgiven 2/3 of it. I mean, we have to pay 1/3, and the other 2, it's counted as 3. The Greeks will immediately think 2/3 of the debt's forgiven. They'll act as if 2/3 of it is forgiven. They'll start trying to pay as fast as they can. What will the Germans think? They'll think, well, the Greeks haven't paid us anything yet. How long is it going to take them to pay us back? They're still tremendously in debt. Maybe they pay, a few billion euros this year, okay? We have to count it triple. That's not like 200 billion euros that we have to forgive and, bail out the ECB and raise huge amounts of money. It's 10 or 20 billion euros. That's not going to ruffle so many feathers. We can do that. Meanwhile, the Greek debt is still incredibly high. They can't borrow again. So the Germans are going to think, okay, eventually we may have to forgive the debt, but for a long time the debt's still hanging over them. If they don't do what they're supposed to do, the plan gets canceled, and then the debt's still there. So Germany maintains all the leverage and power over Greece because the debt is still there, and if the Greeks screw up, then the plan gets canceled, but the Greeks are going to act as if it was forgiven right away. So that was the plan. So I went to the IMF and to and tried to sell the plan. And I went to Euclid Tsakalotos and tried to sell the plan. And he said, well, I like that forgiveness, but you can't say that we're not capable of paying. I said, what do you mean I can't say that you're not capable of paying? You're not capable of paying. And he said, we promised the Germans we could pay. We went back and we said, yes, we will pay. What we have to do is convince them that we've we've accepted their terms, we've kept our word, and now that we've kept our word, they're going to see we're virtuous and deserve forgiveness, and they're going to forgive us. We can't say we can't pay, and therefore you should forgive us. So I went to the IMF and I said, well, what do you think of the plan? And they said, well, anything that gets the debt lower, we're in favor of. If you get Sakalotos to say this is what they want to do, then, we can work, we'll see if we can work something out. But he wouldn't do it. And maybe it's a crazy plan, but that was the plan. So I end with that thought that it's the leverage cycle that's caused a lot of our problems, and the end of the leverage cycle is too much debt that can't be paid, and the only way out is to recognize that it's better to forgive. Sometimes you have to be clever about how you forgive, but you have to forgive. Thank you. Okay, I've taken almost all the time, but if anyone wants to ask a question, I'm happy to try and answer.
Last night you talked about the people of Venice, and yes, when Shylock lost his money because he didn't get paid back, surely that would have had a cascading effect because Shylock was an optimist and a developer, and he had borrowed money in the promise of getting return from the people he had loaned to. My question is, what are the particular indicators in the financial world that you watch to see that might be triggering events, the financial butterflies that caused the hurricane?
Okay, so I'll repeat your question. Very good question. So Shylock actually didn't have the 3,000 ducats to lend Antonio and Bassanio. He borrowed them from his friend Tubal. So that meant that there could be a cascading series of defaults if Shylock doesn't get paid back, Tubal doesn't get paid back, and who knows who Tubal borrowed the money from. So the question, I think, was, if you're advocating forgiveness, don't you have to be careful that you might be starting some terrible cascade that's going to have a huge effect? So my answer is, the whole point of my forgiveness is to do it in cases where you're going to get more money back, not less money back. So the idea was to ask these community bankers, change the terms, write down the principle, if you think that's the best way to get money back. By reducing the amount owed, you can often get more money back. They're not going to get any money back from Greece if somehow things by one charade or another aren't partly forgiven. The only way that the Germans are going to get repaid is by making the Greeks understand that they don't have to hit 180 billion euros, which they can't pay back. So in the subprime case, we don't have, so this is partly conjecture on my part, but in the subprime case, we have data. Remember, I'll repeat my story. The people who got thrown out of their houses, when they were told they were being thrown out of their houses, they got very uncooperative. So they didn't do anything to help the lenders, not surprisingly. And they got to stay in their house for a couple years before the courts moved. So the average recovery out of 160,000 was 35 or 40,000, a terrible recovery. If you could forgive 160 down to 90 and potentially get more back, you're not going to start a cascade. Now, the Obama administration made a mistake, I think, because someone else suggested it. A lot of people were saying, let's forgive all the debt. Let's forgive huge swaths of debt. If you forgave huge swaths of debt, Fannie and Freddie debt, for example, and suddenly the banks had to mark their positions down, the banks would lose a lot of money. Maybe they'd go underwater, and that would start a cascading effect. That's the kind of thing you're thinking of. But you see, the subprime loans were so. Now, why is this the case? It's because if a bank makes a loan, if I'm a banker and I lend you the money and you're still paying, I can count it as 100. I don't have to mark it to market. If I'm a hedge, now where my other hat is a hedge fund, I say that subprime borrower is 60% underwater. He may have paid the last few months, but he's going to default sooner or later. So I say his loan is only worth 50. Probably will get 23 out of it, not 100, but the bank can still count it as 100. So they don't have to mark to market. So the banks maybe would have to take these big losses. And the Obama administration, you see the people in power who have the view that it's all confidence. You just restore confidence, you can restore the economy. That's a bank-centric view, because that means you don't want the banks to go under. So everything you do should be to help the banks stay afloat. So you want to keep the banks afloat, you don't want to keep Main Street afloat. So the banks who held subprime mortgages, they were securitized. Then by law, they had to mark them to market. A loan, they don't have to mark to market. But if it's a securitized, market-traded thing, they can't lie about what the market price is. So those they had to mark to market. So my claim is that the market price, which is determined by these hedge funds, when things started to get forgiven, would have gone up, not down. So it wouldn't have started a cascade with the banks suddenly having to mark things down and going under, and then the next bank going under, and so on. I think it's a very good question, but that's the whole point of the plan. It was to start forgiving people who hadn't defaulted yet, so it's not a moral hazard, whose house values went down, they're underwater, which was also beyond their control, and for things that were securitized and already marked to market, precisely to prevent your cascade and not to cause a moral hazard. Yes, absolutely. We should have been doing that.
What should that have been?
Well, we should have been, okay, so I'm advocating when leverage is going way up and you see the price of the thing that's being leveraged go way up, that's a sign to me when the credit surface gets very flat and the collateral price goes very quickly up. That's a sign to me that credit conditions have gotten too loose and the Fed should stand in and not just say, we're changing the interest rate. It should say, like the Bank of Israel, you may know that Stan Fisher was the #2 guy in the Fed under Janet Yellen. He was the head of the Bank of Israel during the crisis. And he said, housing prices are going up too fast. The Bank of Israel declares that no bank can lend at more than 60% LTV on a house. So that's what I'm advocating. And we don't do that. Our Fed has never done that. It has the power to do that, but has never done that. Now you can see how that's politically very difficult to do, because there are a lot of people who can't buy houses because they don't have the cash, and they're going to be upset. But that's what I'm advocating. Yes.
You may have just answered my question, but you were talking about credit surfaces, and you were talking about there's the commercial credit surface, and then there's sort of the housing market credit surface
and the consumer loan, right. And
you were saying, well, let's suppose that one credit surface, you were pointing out, I think it was the housing surface, was different than the commercial loan.
Right.
And you were saying, therefore, the Fed should do something to affect the credit surface that was poor. And I was just wondering what suggestions you'd had for say, correcting the housing surface.
Okay, that's a very good question. So I was... So let me make my point again, but I didn't quite go as far as you said. I said there are the Fed just seems to change the interest rate. That's all anybody knows about, if you read in the newspapers, is the Fed changing the interest rate. But those changes it's making are affecting these three credit surfaces in interesting ways. So my first claim was that the Fed should gather, it's much easier for them to get the data than it is for me to get the data. Actually, this credit surface was drawn with the help of the Board of Governors at the Washington Fed. But I should step away and let them do it all. They should produce this every 3 months. That was my first suggestion. My second suggestion is when they have their conversations, they should be talking in terms of what effect they're going to have on the credit surfaces and which ones they want to affect. Then we'll know whether they really know what they're doing. And they'll know what they're trying to do. And then my most daring recommendation, which I didn't quite make, but I actually probably did make it, I meant not to, but I actually believe that they should try and directly go in and affect credit surfaces that they want to. So how could you do this? Well, they did it during the crisis. What happened in the crisis is that the student loan market collapsed because nobody was willing to buy the student loan securities. The car lending market collapsed because no one was willing to buy the car loans. All these markets were collapsing. The Fed realized that the whole economy was going to go under. So what they did, it was called PPIP and another program, TALF. So what they did is they went and they said, if you want to buy a housing securitization, we'll lend you 95% of the value, even though the credit service was such that the market was only going to lend them 60% of the value. We'll lend at a higher LTV than the market will lend. And that's the way they could increase leverage if they wanted to. The way they could decrease leverage is do what Stan Fisher said. You just can't loan at higher than 60% LTV.
Okay, I think we have time for one more question.
No.
So there were two things that I didn't hear you address in talking about the mortgage crisis. One was the development of interest only, which
Yes.
was predominant in the subprime.
Yes.
The other is the fact that forgiveness of debt is a taxable event to the person to whom the debt is forgiven, and it's treated as ordinary income by the IRS.
Yes. Well, okay. So there was the taxable income, and the first one was the, sorry, what was your first question? Oh, interest only. Okay. So one of the interesting things that happened in the crisis is that the mortgages started getting more and more complicated. So there were interest only, there were negative amortizing loans, there were a whole series of loans like that. So interest only means instead of paying, you pay less basically at the beginning, and eventually you're going to have to pay more. So, and negative amortizing means you might not pay anything at the beginning, and eventually the principal is going to go up, and so you'll eventually have to pay down a higher principal. Now, it turns out that those loans all defaulted more than the more conventional loans. But you know, you could say that each of those loans is a surreptitious way of adding a higher LTV. Because if you're not paying anything for 3 years, and so the principal, the amount you should have paid gets added to the principal every year, the principal started at 100, and you know it's going to go to 107, 114, and so really, if you look out just a couple years, it's a much higher loan than it was at the beginning. So I think your point is, I'll guess what your point is. Your point is that these kinds of loans fit your story of high LTV, but they don't fit exactly into your credit surface because you have to do a calculation now. You just can't look at the terms of the loan, how much is borrowed, and figure out what the correct LTV is. You have to take into account the structure of the loan and therefore do a more sophisticated thing to get a meaningful LTV. And so is your credit surface really that useful? I think that might have been your question. So, well, anyway, let's ask that question. So, so yes, I think that you do have to do that, and it gets a little bit more complicated. And I think that that's part of the reason why the Federal Reserve, you know, the New York Federal Reserve is also working on these credit surfaces, and I think that's why it got them a little bit bogged down, because not everything is a constant interest rate mortgage. They're floating interest rate mortgages. They start at a lower interest rate, and so how can you put them on the same picture? So there's a way that economists deal with this thing. It's called option-adjusted spread. So you try and figure out by doing various calculations what effectively is the interest rate at which you ought to value all those securities. And so I would substitute some complicated computation like that for the actual interest rate given in the terms of the mortgage. So it's going to take a little bit of work before these credit surfaces become usable, but I think even just using the data that we have now, they're usable. By the way, these IO loans, interest-only loans, there are much fewer of them now than there were before. We're back to an older era with much simpler mortgages where these credit surfaces are easier to do. Now, your question about the taxes, I forgot the answer to that. I worried about that. But even if there are taxes involved, you know, with the government playing a role, I think that I don't think that's the reason why Susan Cognac, the lawyer, was involved in this. And now I can't, a good question, which I don't remember the answer to. But so the danger is that they'll suddenly have to pay a huge amount of tax in the first year. And then how are they going to do that? And so it's actually going to hurt them to forgive the loan and not make them better off. But there's a legal way around that. So.
Thank you very much.